This video critically praises Sainsbury's public annual financial reports published in 2018 and 2019, calculates the trend of the company's financial ratio in recent 2 years, and analyze the reason for this phenomenon. The ratio calculated in this video contain profitability, liquidity, gearing, and investor ratios. Based on the result of this analysis, the video provides Sainsbury with some recommendation for improving financial management. Sainsbury is founded in 1869 by Mary Ann and John James. It's a big retail and wholesale company. The company operated various sub-brands and merchandises, including food, clothing, and etc. through its store and supermarkets. Finance is also an area covered by this company. Its name, Sainsbury's Bank, which aims to provide the customer with insurance, travel money, credit cards, and loans. In 2019, there is about 178,000 employees and over 2,300 supermarkets and stores in its business, which guarantees fresh and healthy food and cheap price for customers. In Sainsbury's business strategy, the main value goals of this company is to use cost and differentiated leadership for competing with its peer. Although the company is trying to improve the value of its product and service through differentiation strategy, Sainsbury is still facing the situation of competing with many competitors such as Tesco, Morrison, to seize the customers and marketers. According to the annual report of 2018 and 2019, the ROI ratio for Sainsbury is showing 2.59% and 4.17% respectively. The former is significantly lower, and according to the financial report items, the reason is the increase of the cost of sale and some other administrative expense. Specifically, is related to the change of the fair value resulted from the acquisition of HRG and Nectar. Also, there is some reason for Asta's transition cost and the fee of Sainsbury's bank transition. Second, the shareholders' equity has increased substantially, which is £1,000 million. From 2018 to 2019, the ROCE ratio have fallen dramatically from 4.43% to 2.57%. Although the long-term debt had decreased and the company's equity had increased, the large management costs have made this ratio has had the same performance as ROI, which need to be promoted. And the performance of GPM was slightly increased from 6.61% to 6.92%. Compared with the Tesco and Morrison, the sales result of Sainsbury's supermarket had increased in this period are done better. And as for the current ratio for Sainsbury, at first glance, it's lower than 1 in the past 2 years, and there was a downward trend. This seems to show that the company was currently facing increasing financial risks. Also, the lower quick ratio also shows this financial situation. However, comparing to Tesco and Morrison, the working capital of Sainsbury's was much higher. These retail companies have the similar low ratio of current capital due to the plenty of trade payables. So we can see that the inventory account for the considerable promotion of these company current assets. This shows that retail and wholesale companies generally use working capital to purchase physical goods for storage, and this means that the ratio below 1 doesn't not bring the higher financial risks than other industry. Conversely, the use of the working capital in inventory indicates that the funds have been used efficiently. For the credit days, Sainsbury's needs to make a better possible use of a credit period of the signed contracts to obtain the longer credit days. The credit days of Tesco and Morrison was 57 and 65 respectively. This means that Tesco has more rooms to negotiate contracts with supplier to gain a longer time for repayment of debts, and the Sainsbury is somewhere between Tesco and Morrison. As for the gearing ratio, the Sainsbury is 13% and 36% respectively, shows a relatively stable and moderate risk of financing the fund. And the Tesco and Morrison presented the gearing ratio of 47% and 30%, with 50% was a cutoff point. Tesco should not continue debt financing, and for Sainsbury and Morrison, the lower leverage ratio allows the company to have more room for debt financing. According to the Moody and Miller theory, under tax conditions, more debt financing can inefficiently reduce the interest paid by the company. Thus, Sainsbury's can properly borrow some money from the debtors. As for the investor ratio, the dividend per share of Sainsbury increased from 9.6 pence in 2018 to 10 pence in 2019. And the dividend payoff ratio of Sainsbury remained at 69%, but in 2019, this ratio had exceeded 100%. This means that the company's dividends return to shareholder had exceeded the company's net profits. Based on the above analysis and the results, this video provides Sainsbury with some recommendations in as follow. Although the company's total revenue increased from the last year, due to the unnecessary expense driven from the failure of the acquisition business, the company's net profits had dropped significantly compared to the previous year. Therefore, when considering strategic mergers and acquisitions, Sainsbury need to consider more about the value of the official regulators and with more carefully. And if there is necessary, gives up two difficult goals and aims at the steady and sustained growth of the corporate profits. And second, Sainsbury has shorter debt days, longer inventory days, and medium credit days, which means that the company has more rights for downstream customer, and the bargaining power of upstream supplier need to be strengthened. And the company also need to further strengthen its inventory turnover efficiency. And third, although the Sainsbury's figures on working capital are unreasonable, compared with Tesco and Morrison, this financial feature is common to retail and the wholesale industry. So from the perspective of the gearing ratio, Sainsbury can appropriately expand the borrowing from the debt funds. And finally, the distribution of dividends in the past 2 years has shown an upward trend. In the long-term period, Sainsbury should not continue to increase its dividend distribution because there is no necessary for the company to continue to raise the investors' physiological expectations and for excessively high dividends distribution may bring some financial pressures to the company.